So it seems to me that for publicly traded companies, the multiples do reflect the cost of capital relatively well.
Talking silver here with Peter and Silver Crown Royalties. Peter, listing. There are many different options. We already talked about that in our other clips in terms of the vehicle and the way you could list. And then there's different markets. In an ideal world, you would be listed in Australia on the ASX, in Canada on the TSX, having this heritage in metal trading with the London Metal Exchange. So how do you decide which exchange where you're going to be listed, cost versus opportunity?
Right. So that's a great question. And for us, the decision will be around what's best for our investors and what we think lowers our cost of capital the most. So essentially, where is the demand for the product that you've created the highest? And right now that seems to be London, but obviously there's demand for this product in North America as well, especially once you're up and trading. Australia's had quite a lot of support, and we can see these through multiples. So you mentioned mining companies or specialty mining companies, royalty companies. We can look at these various markets and we can see exactly what the cost of capital is based on what the multiples that they afford are. So Australia obviously has lower cost of capital than North America, and England is probably somewhere in between the two. We could throw Frankfurt in there as well for somewhere down the line. But obviously cost is top of mind, and we have to therefore look at what the most beneficial thing is for our investors in terms of cost of capital. We do talk to them all the time about this, so we have a pretty good idea of what they would be supportive of in the long term, but we certainly are focusing in on the UK and North America, specifically in Canada on the TSXV, and further down the line, once we grow to critical mass, that is 100 million market cap or higher, we would entertain a US listing and an Australian listing as well.
And Peter, for the viewer at home, it might not be as easy to understand cost of capital when you're actually just giving out shares, because cost of capital when you're going into debt is quite easy to understand. The interest rate, that's your cost of capital. But what is the cost of capital when you're actually going to go to a stock exchange? Could you explain that in a bit more detail?
Absolutely. The easiest way to think about cost of capital when it comes to equity is around what your net present value of all your future cash flow is valuation-wise. If you're discounting those cash flows at 10% and you're trading at 1 times NAV, we can assume that that's your cost of capital is that 10%. If you're trading at less than 1 times NAV, your cost of capital is higher. And if you're trading at more than 1 times NAV, your cost of capital is lower. So we can make the argument that if you're trading at 1.5 times NAV in England, 2 times NAV in Australia, and 1 times NAV in North America, then your cost of capital is cheapest in Australia, it's inexpensive in the UK, and it's right around where it should be in North America. If you're trading at a steep discount to NAV, then your cost of capital is really high. And that's where you see a lot of the exploration companies right now, they're trading at 0.1 times NAV, which implies that their cost of capital is more than 50%. These are absolutely brutal terms. The market basically saying we're not really too keen to support this type of thing. Obviously, money has to come into the system, multiples have to go up, and that's when your cost of capital goes down.
I really like the explanation, Peter. I think that was a great overview. And just to simplify it even more, I guess, is the cost of capital is just a percentage that gives roughly the multiple at which you're acquiring your capital. So the higher multiple you can get on a stock exchange, the higher price you can get for your share price, the lower your cost of capital is. And that's just expressed as a percentage to be able to compare it to debt.
And then Peter, talking about capital markets, there are various options to go public. We just talked about the different vehicles, and there are also different markets from the TSX in North America to the ASX in Australia, and then somewhere in between London, also an option for you going forward, and with a strong heritage in terms of the London Metal Exchange. So I think a lot of commodity trading still taking part out of London.
Yeah, I think that the UK also has a slightly different appetite for companies that will be or plan to pay a dividend. So in North America, we've really seen the door shut to private companies that want to raise money, and it doesn't matter what kind of business model it is. The access to capital for private companies in North America is essentially over. In Europe, there is a little bit in a way in that companies that do seek a yield product will be happy to, or will consider at least, participating on a private company basis before the company is public. In Australia, I've not really had that much experience in terms of figuring out what the access to capital there is, and frankly very few North American companies have. I struggle to think of anyone that's actually dual listed or tri-listed between Canada and Australia in some fashion, or US and Australia in some fashion.
Well, just wait till February, because Usha, lithium company listed in Canada, is going for a secondary listing in Australia.
And I think it makes a lot of sense. Look, there's big funds down there. I know Regis is one of them. They've been big supporters of exploration plays, and all it takes really is just, come down from from North America and propose a listing or some kind of anything, and they'll be very supportive. So it seems to me that for publicly traded companies, the multiples do reflect the cost of capital relatively well. And in North America, yeah, it's a struggle for most. So looking abroad, specifically in Australia and in England, makes a lot more sense right now anyway.